Hello again. As promised, here's a second video of the day explaining kind of what I'm trading now that I've moved out of my old method. Anyway, here's a plot of the gold ETF, GLD. The thick blue curve is the daily closing price. The thick black line is the simple 10-day moving average. The bands on each side of the black line are simply increasing or decreasing about the 10-day moving average by 2%. So in other words, the outermost bands are plus or minus 10% from the 10-day moving average. I first made these bands without any kind of prior intent. I had an inkling. I wanted to see what they looked like, just for shits and grins, as they say. But I did notice some interesting things. Here I've circled a nice 2-month upswing in GLD. So for the bulk of those 2 months, the price stayed in the 0 to plus 2% and in the plus 2% to plus 4% band. At the end of the upswing, there was a blow off top followed by a pretty sharp decline, and then the stock trended sideways to downward for quite a while. So more recently, we again had a nice 1-month uptrend where the price stayed mostly less than 4% above the 10-day moving average. Then you could say that there's a blow off top at the end of the trend, followed by a modest pullback, and then kind of changing the slope of the trend of the stock price. It's still trending upward, but less radically so. So conversely, when the stock is trending down, the price tends to stay a few percent below the 10-day moving average. So in a nutshell, when I look at this graph, I see some patterns. But to validate whether your patterns are real and real for one, and if you see the trends existing, that's one thing, but even higher bar is whether those trends have any predictive power. And for that, we don't quite know yet. So let's do some data crunching. So in this case, I did the data mining over 301 trading days that went back to October 15th of 2021, ending on January 10th of 2023. So I then counted the number of days that fell into each bucket. So in this case, we have 12 buckets. The first bucket is where the stock price is more than 10% below the 10-day moving average. The second bucket is when it's 8 to 10% below the 10-day moving average, 6 to 8% below the moving average, and so on. Okay, so for the case of GLD, only the innermost 6 buckets are populated because it's not a super volatile stock from day to day. And by far the most common occurrences are between 2% below the 10-day moving average to 2% above the 10-day moving average. So 75% of the total occurrences, to be exact. So then let's, now that we've kind of broken up the data, the daily price data into these buckets, let's look at the average daily forward return in each bucket. So on the bullish side, notice that when the daily closing price is between 0 and 4% above the 10-day moving average, the forward return is positive. However, the best returns occur when the price is between 0 and 2% above the 10-day moving average. So probably this is a reflection of the fact that when gold tends to get overheated, have a blow off top, it frequently pulls back quickly and rather strongly. And when the price shoots even further above the 10-day moving average, as it did on only 5 trading days, the average return was actually strongly negative. So this kind of confirms the correction after blow off top hypothesis, at least for these 5 trading days. So the bear side is also interesting. When the price is between 0 and 2% below the 10-day moving average, as it was 37.5% of the time, the stock declines on average 15 cents on the following day. So it's pretty strongly negative expectancy. However, when the stock falls further below the 10-day moving average, in this case, 2% to 4% below the 10-day moving average, the following day's return is on average quite positive. So this kind of shows that the stock price tends to reflexively correct after a capitulation to the downside. So kind of the inverse of it's more of a blow off bottom. So I've shown that looking at historical data, when the price is in some moving average bands, it's bullish while it's bearish in other bands. But you have to be careful on how you use data mining to draw conclusions. It's possible that the market could be behaving in one way inside the period that you use for training the model, and then the regime could change tomorrow and the conclusions would no longer apply. So I actually remove certain parts of the data set and then compute the histograms for these 3 different subsets of the data. First I remove the first 50 days of the data and then build a histogram. So of the 6 live bands, 4 of them had a positive expectancy. Next, I removed the final 50 days of data and repeated the histogram calculation. And again, the same 4 bands had a positive expectancy. So finally, I removed the randomly selected 50-day window and again repeated the histogram calculation. In this case, 3 of the 4 bands had a positive expectancy, but 1 did not. So what can we conclude? So we had 3 subsets of the data which still contained 250 trading days, so plenty of data points. By removing the chunks of data, I hope to reduce the chance of coincidence or luck skewing the data points inside one bucket. So to choose the final buckets for trading, I simply take the median of the 3 data sets. So in other words, if a bucket was labeled 1 on 2 data sets and 0 on the 3rd, then the median would be 1, and we would use that bucket for trading. So here's the final buckets that I'm using for the backtest and for trading actually. So of the 301 trading days, we were in the market 182 days or 60% of the time. And this seems about right for a stock that's up modestly over the last year, but with many ups and downs along the way. So in other words, we're bullish, but kind of cautiously so. The blue curve is the daily GLD price, while the red curve is the backtest. So when GLD trends upward, notice we're in the market most of the time, and the backtest pretty much shadows the stock price, which is what we want. So however, when gold started trending down in March of 2022, the backtest was definitely in the market less frequently because you can see flat spots where it's out of the market for several days. And it moved sideways to slightly up. So anyway, so for the back test worked. Any of you who've seen a beautiful back test and then felt pain when that back test didn't work in reality will be skeptical. And I've also been burned by back tests, so I'm also skeptical. So what I'm trading my sector ETF portfolio using this method. I've described the portfolio ad nauseum in other videos, but suffice it to say that I trade the 11 spider sector ETFs and 7 hedges like gold, oil, commodities, bonds. I run this calculation for each of the 18 ETFs in the portfolio, and yeah, I'm gonna trade it. So, I can't say I'm the smartest one out there and most insightful, but all I can say is I will honestly trade this this approach for at least a couple months until I get a sense of whether it's probably working or not, and I'll report back in good faith at that time. So I'll probably report back before then, but would love to hear your feedback in the comments and tell me why I'm an idiot for doing this. But anyway, see you in the next video.